Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Fred Moscowitz. Fred is an educator and best-selling author who has trained countless investors from all walks of life on how to create passive income streams on their own. As a fund manager, Fred manages a mortgage note investment fund and is considered an industry veteran within the note investing arena. Fred teaches the concept that individual investors are able to step into the shoes of the lender through note investing and effectively be the bank. And in just a minute, we're going to speak with Fred about mortgage note investing. But first, if you like our show, there's a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Fred Moscowitz. Welcome to CRE PN Radio.
Thank you, Darren. It's great to be here. I'm so excited for our conversation today.
I'm looking forward to it myself. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, absolutely. A little bit about my background. I come from having a very long and successful career working as a computer engineer. I spent a lot of time working at technology startup companies, and it was wonderful. It was so many amazing opportunities that I was a part of. What happened was that I watched my entire industry get turned completely upside down. We lived through the bursting of the dot-com bubble. And then that was immediately followed by the September 11th terrorist attacks. And there was all this turmoil in the world, all across the world. And our industry was in shambles. It was in shambles. And what happened was I realized that I was way too dependent on the income from my job, on that paycheck. That was my only income source. And so I came to this realization that even though I loved my job, it was a job full of all of these circumstances out of my control. And it didn't matter how talented of an engineer I was or how valuable of an employee I was. If things were not going well in the industry or in the company, that I would lose my job through no fault of my own. And so with that, I turned to investing to find other sources of income. And I wanted to generate passive income so I would not be relying on my job as my only source of income.
Got it. So as you were looking for something different, were there any other things that you tried before you settled on investing the way you are now?
Well, I started out investing in real estate. One thing I learned was that I could invest in tangible assets, and turning to the alternative investments area, could invest in tangible assets that would generate income for me while I own them. And that was very important. I was focused on cash flow. And so I started with investing in real estate. I built up a rental portfolio here in Philadelphia where I am based out of, and I did really well with that. That was going well. After a number of years, what happened was through my education, I was pursuing education the whole time, learning skills, learning new strategies and techniques. I learned about note investing, where you could invest in, instead of buying and owning the property, you can instead buy and own the debt on the property and earn cash flow from that. And that was very intriguing to me because I saw that it was something that you could really scale and turn into something big. You could build a very large portfolio, and it was not difficult to scale it. And so that became very appealing to me, and I got involved with that, and eventually has grown to where it's the main focus of my business activity now. And real estate is a great asset, but there's so many ways to invest in real estate. So many. Note investing is one of them. But what's interesting about it is that you own the debt. However, you don't own the property, so you don't have the management headaches of owning the property, or the risk and liability of owning the property. So it does put you in a unique situation.
Yeah, no, I hear you. So let's talk about the mortgage note investing.
Mhm.
Um, I think probably the first thought that comes to mind is, how much money do you need to be a lender? If you're going to borrow hundreds of thousands of dollars from the bank to buy a property, as a private mortgage note investor, how much does a person need in order to get started as a lender?
Yeah, that's a great question, Darren. Let me start out by saying that my focus, what I do and what I teach about, it's about not creating the lending, but we're buying notes on the secondary market, notes that were already originated by someone else. And what happens is they're sold at a discount. So we buy notes that exist already. Either they were originated by a traditional lender or a bank or an institution, and then they're sold on the secondary market. Now, which is different than being the originator of the loan, or originator of commercial a commercial loan, commercial uh, project. How much do you need? There's no limit. It is a capital intensive business for sure, so you do need to have capital. There are notes, small notes that may have a five or $10,000 balance, and you can get up from there, go all the way into jumbo loans, which are approaching $1 million, and everywhere in between. And so there is no set uh, amount on that. And that goes for buying individual notes. And if you invest in a note fund, where you're investing in a fund that's professionally managed, they will have minimums and maximums, but some of them are on the smaller end, maybe $25,000 or $50,000 or $100,000. Each one is different. There's no right or wrong. It's just however the business model is. So really, it's something that you can look at to see what fits best for you individually as an investor.
Got it. So, with respects to the different opportunities, whether it be investing or buying a single note or investing in a fund,
Mhm.
um, can you describe kind of the range of return one might expect?
Yeah, absolutely. Um, I'll give you some rough examples. Think of it this way: it comes down to risk tolerance, right? For you guys in the insurance world, you know all about this. So for someone that's willing to take on very low risk, you're going to get a lower rate of return in exchange for that high security. Now, if you're comfortable with a greater risk, then the rate of return goes up and up. And so this is give you an idea on ranges. If you're investing in super safe notes that are in first position and there's equity above and beyond all of the liens on the property, and it's in a good area, and the borrower has excellent credit, excellent track record, checks all the boxes, right? You might be looking at 5 or 6% rate of return. Now, at the other end of the spectrum, you could get into things that have higher risk. For instance, notes that do not have a perfect payment history and perfect track record, or a borrower that is a little more challenged with their credit history, credit record, or the property might not have a good equity coverage on it, or the loan might be in second or third lien position, right? Could be any of these things. Or maybe it's a loan that's a hard money loan where the lender is originating a loan to an investor that's doing fix and flip projects, and that's a short-term loan, but the rate of return is very high. It's not uncommon to see 10, 12, 14% interest rates on those, and that's why. And so it really runs the full spectrum there. And what I found in this industry is, as you get more experienced, you get more comfortable with managing risk and taking on different challenges. Maybe you're comfortable with solving different kinds of issues, and so you pursue those higher risk, higher return opportunities, which is a natural progression in note investing. It's present in real estate investing as well. People, as they become more experienced, more savvy investors, they will go and acquire a property that has some problems that can be fixed, has some challenges, whether it's a management issue or property conditions issue. But all of these things can be corrected and addressed if you put in the work and the resources to do that, and time. And so when you do that, you become more successful as an investor because you're able to create value, you're able to realize a higher rate of return and greater profitability that way, because you're pursuing opportunities that others may decline to pursue.
Yeah. No, that makes complete sense. Hey, I wanted to ask you, getting back to the, where you are selecting a loan to buy or investing in a fund.
Mhm.
If I were to underwrite an individual or for a specific property, and I'm assuming it would be very similar to, like, if I was going to borrow money myself, they'd want to see financials, want to know about the property, you know, about you and your likelihood to repay. When you go to buy something from, an existing loan that's already in force, how do you get the information you discussed with respects to the likelihood of, the loan being paid and how safe it is?
Yeah,
Who
for
provides that?
for your due diligence, right?
Right, right.
Very important prior to buying a note or investing in a note fund. You have That's the time to do your due diligence, right? And I talk a lot about this in my book about note investing. I have an entire chapter dedicated to how to perform due diligence and the various areas to look at. Now, when buying an existing loan, like you said, you look at the property and the property value and the borrower and their track record. All of that information is provided to you by the prior note holder. They will provide that to you as part of the transaction. You have every right to review that information. You have the right to pull credit on the borrower because you're buying that loan, that mortgage. Um, And so this is very important. You have access to this information, and it's up to you to obtain it, to know what you're looking at, and do an analysis. Now, another area that is very important is loans are typically managed by a loan servicer. And so the servicing company is going to be able to provide reports and data on the payment history and the track record. And so you can review all of that. And that's very important. And let me just add an additional point here. Loan servicers are an integral part of our business and very important vendors. Think of loan servicers as the same way that a property manager manages a rental property on behalf of the owner. The loan servicer manages the note on behalf of the lender, and they take care of keeping track of the accounting, of the amortization schedule. They collect the payments from the borrower. They take phone calls. They send out the IRS tax forms at the end of the year that need to get sent for the interest that's been paid. They handle when a loan is going to be paid off and generating all those documents that's needed, and also all the compliance paperwork and requirements that are needed. So they take care of all of this, and it really is a valuable service. And I would say that at least in our business, we place every single loan with a loan servicer. That's very important because they handle so much of the day-to-day details, and it makes our lives easier, and it keeps us compliant as well.
Yeah, no, they definitely don't want to get upside down or sideways or chasing money. Make it
We have to focus on our business as investors, right?
right.
That's what we do, and so a lot of things it's better to delegate or hand off to experts that's what they're good at.
Sure. That makes sense. So let me ask you this. You're buying an existing loan. Why is the existing lender selling the loan?
Hmm. Great question. There's a lot of different reasons. The main reason that I see it revolves around liquidity. The seller of a note usually needs their capital back, whether it is because they're paying investors back, or they're recapitalizing because they have a new purchase transaction they need to fund. It could be that there is a note fund or a mortgage-backed security on Wall Street that exists for a specific time frame, and after X number of years has elapsed, they collapse that investment and sell off all the assets. And so these are some of the reasons why. But when we buy a lot from individual investors and other note funds and hedge funds. It's usually due to liquidity that they need the capital for something else, and so they'll sell off notes to close out a fund, close out an investment, or raise capital for the next purchase they're doing.
So you mentioned you can buy these at a discount.
Mhm.
If you have an original loan, and let's just use a like a residential mortgage, for example, a 30-year fixed rate of, I'm trying to think, currently, I think you can get rates around 5, but recently they were as low as, in the threes or below. Um, you'd mentioned these 5 to 6 and 10 to 14. Are these notes not like an individual mortgage? Are they typically more of like a commercial nature?
No, they're often residential mortgages.
Okay.
Absolutely. There's both types for sure. Um, but some of the things that impact pricing may be that the loan the loan might be in second position. For instance, we buy a lot of junior liens. There's a lot of nuances to that space. It's niche, area. Um, and so that's perceived as a higher risk. And with that, there's going to be a greater discount. Another thing you'll see a lot are notes that they're being paid on, but they have a less than perfect track record. Maybe there's been some lapses in payment history, or the borrower is 1 month behind. However, they're still paying every month. When you have these scenarios, um, that's going to change the grading and the risk, and those will trade for a greater discount. Or if there is equity, whether it's not full equity coverage, or maybe the property's underwater. We saw a lot of that about a decade ago, where notes were bought and sold and there was not enough equity to cover the lien. However, it's still a valid lien. The borrower is still paying on the note, right? People want to stay in their house and live there. They're not going to get up and move because the property value had dropped. And so you would see a lot of these different scenarios. And when that happens, that changes the valuation of the note.
Got it. And with like a second or a third position,
Mhm.
again, the further you get away from being the first, the rate goes up, the
It
risk
does.
goes up. Um, is there sweet spot you find for the from the length of the loan? Meaning, in year one, it's worth more than it is when you're five, or they get. Is there a grade on the value of the loan based on length of
Not
time from origination? Or
Yeah, not so much. Not so much. Really, what's interesting is that's something that's less important to look at. And here's why. This is a really interesting phenomenon. Most common we see are 30-year fixed rate mortgages, right, here in the US. However, the average, do you know what the average life of a residential mortgage note is in the United States? Historically, it's 5 to 7 years. It's 5 to 7 years before the borrower will refinance and pay off that loan, or they'll sell the property because they're moving to a larger house, or moving because of employment, or downsizing to a smaller house. All of these life changes that happen to everyone as part of life. And so that creates an element of randomness in our industry where, yes, you may have bought a 20 or 30-year note. However, you never know when the borrower is going to pay that off, and they have the right to pay off at any time. And so it creates an element of randomness because you never know when that may happen. And when you start to manage a larger portfolio, there will always be notes being paid off. And so capital is going out because you're buying new notes. Capital is coming back in because notes are being paid off. And so it's a dance to keep as much of your capital deployed and at work at any given time. When you're managing a fund, managing a note portfolio, a larger portfolio, this is some of the larger, higher level dynamics that happen. And if you think about this, if you're sitting on capital undeployed, it's going to create a drag on your overall rate of return because that money is earning zero for you. So it's only when you put it out in the form of acquiring notes or lending that it's generating a return for you. And so that's always something to be looking at and to balance in a portfolio. But it's really interesting. As I said, that element of randomness, you never know. You never know. I've bought notes that 1 or 2 months after buying them, they got paid off. And if you negotiated a good discount on it, the payoff comes for the full amount of the debt. So that discount, becomes profit, which is nice. But then there's other notes that you can own for 5, 10, 15 years, and they're paying, and you're making money on your yield, and that's fine too. And so having a mix, having diversity in the portfolio, it helps to round that out.
Yeah, definitely. I get the kind of the diversity thing there to try and mix it up, and it sounds like, similar to real estate, a lot of the value you can create is in the upfront and the price you pay for the loan. So
Yes.
if you can get a significant discount, uh, and then if the borrower pays it off right away, I mean, home run, that you make all your money in a hurry. Um, so let me ask you, so the opportunity for private lending, is it a constant? Does it go up and down as does the the published Fed rate? Does it go up and down with the economy? Is it just always there?
And you're talking about originating private lending?
Well, just the opportunity to be, whether to be, buying secondary notes, or, the ones that
Okay.
are existing, or I mean, I guess both ways.
Yeah.
Originating, is there a constant demand for this?
Yes, absolutely. There's a constant demand. People are always buying property, no matter what the real estate market looks like. And most of those transactions are financed with purchase money financing. And so, that's something that all the time, it doesn't change. What changes is usually, with the real estate market, is demand, is um, risk profiles, property values change, and so there's always adjustments being made. However, all the time there's a demand for lending, because here in the U.S. there's not a lot of real estate transactions that are funded as an all cash purchase. And if they are, you hear about them. You see a lot of that with investors, particular. They'll buy a property all cash, but then after the property gets stabilized, then they'll go and put a loan, take out a loan on it, put financing, permanent financing in place. And so really it's at the heart of most transactions. And so there's always a demand for that, for sure.
So going back to the first question I was asking about, how much do you need? Where do, or I guess let me ask it this way: do most people just invest, some liquid cash they have, or do they look to the retirement funds to put to work
Yeah,
investing, or how do people capitalize for doing this?
that's a great question, Darren. And the answer is both of those. You hit the nail right on the head. It's either liquid cash. We see a lot of interest in buying and investing in notes, or investing in a note fund from someone that maybe just sold a property, or they just exited from another investment and they have liquidity. But in addition to that, is using retirement funds, retirement account funds. And when in our business, I talk to investors all the time. And this is something that the majority of investors actually leverage this strategy, using self-directed retirement accounts, whether it's a 401k or IRA funds. Those funds can be used to invest in mortgage notes, or invest in real estate. And it's a great strategy. I always feel like not enough people talk about this or actually use it, but you can absolutely, if you have an old 401k plan from a prior employer, or you have an IRA, you can put that capital to work in note investing. And what I love about that is that you're investing in an investment that has tangible value, right? It's backed it's an asset backed by real estate, has tangible value, and so that's a really good security for your capital. And so I find that very appealing. But those are the ways that that people can invest in notes, and that goes for investing in individual notes if you want to build a portfolio, or investing in a note fund that's professionally managed. You can absolutely use retirement account money to do that. And it's a very powerful strategy. And what I really love with that is the preferential tax treatment, especially if you have a Roth, like a Roth IRA, and then you own notes, or you invest in a note fund. All of your returns, all of your profits, it's tax free as a Roth, right? And so that's powerful. That's very powerful. The growth in that account over the long term is phenomenal.
Yeah, no, love the Roth. That's a great option. Let me ask you, in your experience, what is the rate of failure, portfolio wise? What are you seeing if you have 100 loans or 1,000 loans, over the life expectancy of those? What's the industry, or what's your experience for failures?
Yeah, that's a great question. It's very low, actually. Very low. And in particular with the way the real estate market has been, even though we just went through a pandemic and there was a lot of turmoil, we did see some some notes where borrowers were impacted by the pandemic. Either they stopped work, or they got sick, different things. And so there was some people that got behind. But eventually what happens is people get, with enough time, they get these problems worked out. And really didn't see much with of serious problems all throughout the pandemic, which was really good. Something to think about with this, is that there's always some rate of default in a loan portfolio. It can be kept low through good due diligence and good management of your notes, but it's not perfect, right? It's never perfect. There's no guarantee, but most times what I find is that with enough time and having the right people and resources working on it, just about every problem can be resolved, come to a resolution, and come out as a win-win scenario for everyone moving forward.
Got it. And I would assume that the fund model would give you a little bit of insulation, where you wouldn't necessarily be the single sole participant owner of a note, but more like a percentage of a note, or that would be owned by the fund, kind of thing, as opposed to if you were holding the note that failed, kind
Yeah,
of thing.
yeah, that's a great point, Aaron. What happens is that if you were investing, let's say you were investing $100,000, right? You could go and buy one or two or three notes with that, maybe. And all your capital is spread out into those few notes. But if you invest in a note fund, your investment now gets spread out over hundreds of notes, maybe thousands of notes. And so there's so much diversity there, and it just really adds an element of stability into your portfolio and into your cash flow stream. And that's one of the nice advantages of that. It's that diversification within the portfolio.
Got it.
And if one additional point, because you're an insurance guy, I know this is going to resonate with you, but how do insurance companies manage their risk, right? It's by not writing a policy on one person or one building or one property. They insure a pool, spread out, diversified. And so that The strength of the pool is what carries the whole insurance company, keeps it liquid, keeps it moving well as a good entity. Because yeah, there may be some claims here and there, but not likely that all of the insureds, all the policies are going to have a claim all at the same time. Highly unlikely. And so it's the same thing. And so I like to say we take a page out of the playbook from insurance companies in the note business by doing that same thing. Have a portfolio, and now your risk is spread out into that diversification among many notes, and that's wonderful.
Yeah, no, that makes a lot of sense. Do you guys use any kind of algorithm or any kind of you know, computer modeling to determine kind of level of risk, or is it more of kind of like a one loan, one review kind of a scenario? I mean, is it are you doing all the underwriting individually, personally, or is there more of a model that you guys look for that if you're buying like a pool of loans from a lender?
Yeah, it's a combination of the two. We absolutely look at each loan individually when we're buying. But in the beginning, when we're looking through many loans, we'll definitely use some modeling to kick out loans or exclude loans that maybe don't meet the criteria we're setting. And so that's very important to do that. But there's a lot of great tools and modeling that can be done to help you with that if you're looking at a larger portfolio.
Got it. Hey, Fred, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guest if they can look at their own situation. It could be clients, investors, political, the Fed, weather, whatever it is you consider to be the biggest risk, but identify what that is, and let us know what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Fred Moscowitz, what is the biggest risk?
Wow, this is a great question. There's many risks. That's a big part of what we do as note investors is get good at understanding what they are. As I said earlier, diversification is a great way to manage risk in a note portfolio. But some other areas, it's really getting good at doing your due diligence before purchase. As I said, I dedicate a large portion of my book to this topic because it's so important. It's prior to buying, running your due diligence, and surrounding yourself with the right individuals to help you, whether it's vendors, it's data providers, to get you the resources and information. It can be another area super important is counterparty risk. When you're buying a note, who are you buying from? This is a big one. You want to make sure you're comfortable with who, and this goes for any business transaction. Are you comfortable with who you're entering into a business transaction with them as a person, with their company, their reputation and track record in the industry? I feel like this is something that often gets overlooked or doesn't get enough attention to it because deals can go bad. Transactions can have problems, they can go bad. And so what's very important is how is the other person going to respond and cooperate and work with you to solve a problem that comes up? Because We live in a far from perfect world. And so you want to know, how is the other person going to show up and resolve this issue? And that matters so much, so that you're comfortable, that you can work through an issue, you can still be friends at the end, and walk away knowing that everyone got a fair transaction, and you're looking forward to doing the next deal again in the future. There's nothing worse than walking away from a transaction saying, never again am I going to deal with this individual or this company or this client. It's so all these headaches. It's the worst feeling in the world. And so that's something you can avoid up front, something you can easily avoid up front. And that's, I would say, a huge risk that a lot of people neglect to think about or talk about.
Yeah, no, definitely want to know who you're dealing with, and otherwise you might find out the hard way once it's yours, and that can be expensive. So that's good to know. Hey, Fred, where can the listeners go if they would like to learn more or connect with you?
Thank you. Thank you. Appreciate that. Best way to connect with me is to visit my website, which is fredmoskowitz.com. Or if you prefer, I have an easier spelling for you. You can go to giftfromfred.com. It'll take you right to my website. And once you're there, you can learn more about me. You can connect with me and request a copy of a special report on note investing. Be happy to send that out. And my book is available on Amazon, which provides a great overview of the industry and note investing as an asset class and how to get started, how to get involved. It's called The Little Green Book of Note Investing, and it's available on Amazon. Oh, one more thing. If you prefer to use your mobile device, you can connect with me by texting. Text the word money to 215-461-4433, and then follow the prompts. I look forward to connecting with you and interacting with you. I always love speaking with investors and learning about what they do.
Awesome. Fred Moscowitz, thanks for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, Darren. It was my pleasure. Thank you for having me on the show.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.